Hey Bay Area, your guide to navigating the exciting world of Bay Area real estate. While I would usually be taking your calls live right now, this week I'm exploring the stunning beauty of Switzerland on a short spring break. But don't worry, I'm still here to help. Today, I'm thrilled to bring you a special episode with the fantastic April Held, an expert mortgage consultant from Loan Law. We are diving deep into everything you need to know about the Bay Area's real estate and mortgage landscape. It's your one stop shop for real estate insights. Got a burning real estate questions? Even though I'm out of the studio, I'm still available. Visit nagarajhomes.com or give me a call at 858-880-4577. Now, let's kick back, relax, and let's get this real estate conversation started. April, welcome to the show.
Thank you, Nagaraj.
How is your day out?
Wonderful. Great
Yeah,
day.
market has been crazy, right? Most common question, April, like a lot of people ask is like, how much you can really afford, right? Like before starting that conversation, I would like to understand how are the rates in this week or like how it's been going in around the mortgage rates.
Inflation seems to be our nemesis.
Mhm.
Yesterday, there's been a lot of talk about inflation, and we had a little bit of a rough day yesterday in mortgage-backed securities. So we're watching the inflation. We do think they're going to increase. Rates went up a little bit, but they're still holding very strong right now.
Do you want to ask your lazy assistant how is the rates going on today?
Oh, yes, yes. Oh, that's June. Yes, my other lazy assistant. June, what do you think they're gonna do? She
Maybe he
doesn't know.
says US, you don't know where it goes in the rates always, right? Like it's
She
so many
doesn't know.
fluctuation factors will be there. But how are the rates right now? The arm rates and 30 year.
So yeah, so ARM rates are still doing really well. They're at 6.25%. The good thing about the ARM rates are they do not shift because they're a shorter locked time period. They
Mhm.
don't fluctuate quite as much as the fixed rates for 30 years. Obviously, if you're guaranteeing a fixed rate for 30 years, it's going to fluctuate a little bit more. So our ARM rates especially, they don't fluctuate quite as much, and that's still a really good interest rate.
I tell you, like a lot of clients call me up saying that Nagaraj, the rates are going up. What do you think about it? But I tell them, dude, it's still not so much differences on the rate perspective because the arm rate doesn't change very fast, right? Now, let's as I was telling you in the initial show, right? Like we need to touch upon uh, how do you qualify, right? What are the points to be considered, April?
So that is a lot of times a big mystery for people. They're nervous, they don't know how to qualify. So the main things, obviously, if somebody's a W-2 employee, we're
Mhm.
going to take that whatever their current salary is. So we take the current salary. We can also use, sometimes people have overtime or bonus, and then also RSU income. So when it comes to, say, bonus income, and RSU income, we just have to take the last 2 years history of that. But we
Mhm.
can use those factors to help, because many folks nowadays, especially in tech industry, RSU income's a huge portion of their income. So we
Mhm.
can use that too. Not all lenders allow that, but we can definitely use that, and that really helps people to qualify for a little bit more.
I think before continuing, listeners, you're listening to Real Estate Playbook. I'm Nagaraj Unaya, your host, the realtor. I'm having a conversation with an April Eld, and we are talking about how much you can really afford in the Bay Area real estate. How do you go about? Because a lot of April, reason this question I brought you in, and we need to deep dive into it because a lot of folks who is especially first time home buyers, right? They go just simple calculators or online calculators, like for example, Redfin or a Zillow calculators or some calculators, and they caught upon like, hey, like I think I can't qualify, and maybe my mortgage payments are too high, right? Talking to the expert makes a difference which they don't know. What do you want to say about like the DTI ratios? I think we need to talk about the DTI ratios. I think let's go with the two case scenarios. One is a straight W2 incomes, correct, and always the DTIs. So then we can touch upon the employed also business also.
Yep. So for but for both W-2 and for self-employment, we can do debt to income ratio of 50%. And
Mhm.
that's gross income. That's not net income. So we can use their whatever their total qualifying income is.
Mhm.
They can qualify for a payment of 50% of that. And that includes also any credit card, minimum monthly payments, any auto loans and that sort of thing. But that's a pretty great amount. So, you know,
Okay, I think maybe there's a lot of first-time buyers. I think maybe they don't understand what is a debt to or DTI also, right? Like, so let's give an example to them also. For example, they're making it 10,000 a month
yeah.
before taxes.
Yep.
Before tax.
So for 10,000, if you're making a 10,000 a month, basically we can go up to 5,000 a month payments. And
Okay.
that includes principal, interest, property taxes, homeowners insurance, and then also any minimum monthly payments on credit cards
Mhm.
or auto loans or installment loans.
Okay. So, and even the credit cards also, the minimum payment needs to be considered. Is that correct?
That is correct. So, you know, what a lot of people are, hey, they go buy a car, they go, you know, finance something. Always a good idea if you think you're going to be purchasing a home, do that first.
Mhm.
Get pre-approved and then talk about if there's room for some of the other expenses. If your goal is to purchase a home, do that first, or at least talk to an expert.
Yeah, I think, see, before talking about other components like RSUs and also, right? I think I tell a lot of listeners out there or my buyers which I'm working with them. Always depends on the lifestyle considerations also, right? Like some people don't want to stretch more self to their limit, but I always tell them when you're getting in a pre-approval, okay, go for a higher amount and get it pre-approved because the Bay Area market the prices fluctuate so much. So getting to know how much you can qualify because you might start with an $1 million right now. Okay, but you might not like the homes with a $1 million itself. So maybe you're liking instead of a two-bedroom, you're liking for a three-bedroom homes. In that time, knowing to your maximum limit always helpful, correct?
Absolutely. It allows the flexibility for them to get the home that they want. And then we can also talk about payments. You know, talking about different purchase prices, you know, it makes people then feel more comfortable if I can give them payments based on some different options. I'm always available to do that along the way. So it's always a good idea to get pre-approved for more and then discuss all those options along the way.
It's a one time. I think one more biggest mistake what I've done, what I've noticed is the buyers doesn't want the credit score to be pulled. I think that's the biggest mistake. What do you think about that?
Absolutely, because so much of qualification has to do with credit score
Mhm.
and also debt that's on there. So
Mhm.
it's actually nearly impossible to guarantee that somebody's going to have a loan when they get an offer accepted unless there is a pull of their credit.
Okay. So
Um,
now let's talk about the RSUs component when you're qualifying, right? To understand how much they can really afford. So do you need a minimum of 1 year of vesting thing, or like what's the minimum years you look for? Or like, for example, if somebody has joined a company now, okay, they don't have the RSUs vested, but they can show the RSUs in the future. Will you consider for their qualifications?
Absolutely. We can take the RSU vesting agreement and
Mm-hmm.
which is going to project what that would be. And then we take a average of the stock price.
Mm-hmm.
And by doing that, we can go forward because obviously that's guaranteed income that they're going to receive in the future.
Listeners, you're listening to Real Estate Playbook. I'm your own realtor, Nagaraj, and I am talking to April Lyle and conversing about how much house you can really afford and how can you go about it. Because there are a lot of home buyers have a misconceptions looking at the Redfin calculators or the calculators is the best way to go for it. No, that's not the right way. Talking to experts like me or talking to an April Lyle or mortgage consultant, that gives you real insight and understand how much you can afford. So April, like going forward on this RSUs component, right? Some people have an ESPP also. Is that also is considered, or like how is that works out?
It is not because they can buy those stocks later on, but it's not a guarantee. So that usually cannot be cannot be used.
Okay. So, and one more thing is like before touching upon our business incomes, right? I think the second one is the wife part also, right? How good is that when they add the spouse also should for the qualifications? Is it a good idea to get it added when they get the pre-approvals?
So in many times that could be really good idea, especially if they also have income to contribute. That can be really good. If they do not have income to contribute, they can still go on and would be a benefit as long as they don't have a lot of additional debt that would also contribute to the debt ratios.
Yeah, I think especially the depth ratio or like it's where I think if they're like, for example, they can't qualify for 1.5 million, right? Only as an individual, then it's a good idea to bring in the wife's income also, even it is like it might be a part. How about the part-time income, right? Like for the wives, some of them are working as a part-time. How can we consider that one?
Yeah, and we can use the part-time income, absolutely. So we qualify that just like any other income. And we can just keep in mind that even if we start with both people and we realize that, hey, it's actually going to be better with just one person, we can take the other person off and take the other credit off very easily. Or if we start with one person and need to add the second person, we can do that very easily either way.
And yeah, I think most of the time when you add husband and wife, right, one of them has the bad credit score, one of them might have a good credit score. Let's touch upon that scenarios also. That is very important because I've seen sometimes wife might have shopped, forgot to pay the credit cards, and that credit score
Yes.
might be less, but maybe the other one has a good credit score, but they need to qualify for a bigger amount now, loan amount, correct? I think how do they go about it?
So basically, that kind of is in my wheelhouse because they apply, and that's what I'm basically trying to do is figure out how can they get the best loan and what scenario creates that best interest rate and loan for them. So many times, if I pull up credit and one of them has a lower score, I may say, you know what, it's better to take this person off because you can get a better loan with this credit score and qualification.
I think I remember. I think last month when I was working with you on one of the file and one of the buyers, right? I think, yeah. Thanks for helping them out. Like as we are discussing in like one, I think husband had a very bad score, and I think wife had a good credit score, but you got an exception for them from the lenders. How are the scenarios when we go get an exceptions? Is the lender sometimes are okay to get an exceptions for a lower credit score also? How does that work? How is the rates fluctuates also?
Absolutely. So with my investor, they are a little bit more not black and white. And so I felt at first maybe it was better to apply with the wife. And I explained that the husband was making lots of money, but he had a lower credit score. And they said, you know what, we would rather have him on the loan with the lower credit score. So many times that, yes, they will make exceptions to credit score without giving a higher interest rate, giving them still that low rate because they look at the scenario and say, what is the chance of default? Well, probably, a low chance of default. So we're willing to take that chance on this scenario.
So, listeners, you are listening to Real Estate Playbook? Myself, Nagaraj Anaya, and I'm having a conversation with an April held discussing about the loan scenarios, like how do you basically get qualified? What are the things to be considered? And we are talking about like husband and wife adding as an to qualify like for the loan purposes. So it's a great thing what you told, right? Like basically sometimes when you talk to the lender, we need to explain sometimes if the credit score has dropped, what was the reason it has dropped, correct? I think maybe sometimes they look at the long time the credit history, and based on one default maybe they're okay to consider it.
Agreed. A credit score does not always tell the full story of the borrower. So having that, there may be extenuating circumstances in which they didn't pay something on time, but that doesn't tell their whole story. So telling that story to the lender is very crucial and can be very helpful.
But it doesn't mean you should not keep your credit score, right? I think listeners, like if you're like bought anything on a credit card, right, and if somebody is offering you a credit cards for free, or they say like 10% reduction, you should think twice, because holding that many credit cards and payments wise, if you don't make it promptly, then
Yes.
your like scores will be, do you, I think, do you have any experiences like that? Some of the clients, April, I think.
You know what? I actually do because it's funny. When I was younger, I used to do that and say, "Oh, I think I'm saving money," and I'd take out these credit cards. But I
Mhm.
see many clients that have a lot of those, and because they're getting a lot of inquiries, because they have a lot of accounts, and most of those accounts, they're only giving them a small line of, say, $500. Well, what happens? They probably charge $500. Now their utilization of credit on that particular account is actually high. So that goes against them in their credit because it looks like their credit card is maxed out. So looking at it now from my end, which I thought I was a little savvy when I was younger, I go, oh, that wasn't so smart. So that can, even though it sounds like a great idea to save some money, may actually hinder your credit score a little bit.
I think that's why I'm very, very careful if somebody offers me a credit card, right? I just have only one or two credit cards. Try to limit myself. That's what listeners, when you're buying, especially if somebody offers you a free credit card or offering you $300 or a $500 on a credit card off, be careful because it's easy to get, but even it scores gets impacted if you don't make the payment. So that is a one thing you should be very thing noticeable, or like be careful when you're buying the credit cards. And the second thing, what's the minimum credit score you're looking for, April, like for the qualification scenarios?
So under normal circumstances, a 620 and above is normal conventional financing that you'd be looking for. We have options and exceptions below that. And actually, I can do certain circumstances down to a 500 credit score. However, that would be up to certain loan amounts, which, aren't always going to fit the Bay Area.
Yeah, and listeners, like I'm Nagarajanaya, your own Bay Area realtor. I'm having a conversation with an April L on the loan scenarios, like how much really you can afford. That is very important when you're buying a house in the Bay Area real estate. So we're discussing about the credit scenarios and everything. So, for example, if somebody is, I think good to know that like this credit minimum is a credit score is a 626 or 620 or above. But if somebody has a 600, the payments will go up. Like, can we get an exceptions for them, or how does that work?
Yeah, so in that circumstance of the clients that we just helped most recently,
Yeah.
I think his credit score, if I remember correctly, was just above, it was under 620. I want to say it was above six, a little bit above 600, maybe 603.
Mhm.
And in that case, my investor said, no, that's fine. Their ratios are very reasonable and allowed them to have the same interest rate as they would offer with his wife's credit score, and took his wife's credit score, which was much higher. So it doesn't always, there's lots of creative things that we can do.
Mhm.
Just have to explore those options.
Listeners, you're listening to Real Estate Playbook. Myself, Nagaraj Nayan. I'm in conversation with an April L. And any questions on the real estate, you can reach out to us, and we'll give out our numbers later. So we are discussing about the credit scenarios. Now let's shift our gaze towards the business income, right? One partner is doing in a business. So how does that they qualify for it, April?
Yeah, so basically with self-employment, there's a lot of different structures for it. But if they have business tax returns, we can use both their W-2 income that they pay themselves for the business.
Mhm.
Many cases, they also have their K-1s, and which come as a Schedule E on their personal tax returns. We can use that as well. There
Mhm.
are a lot of things that we can add back in to maximize it, such as depreciation,
Okay.
depletion. So there's definitely someone that knows business tax returns. I probably know more about business tax returns than I ever wanted to, but
That's
it's a good thing, it helps somebody to qualify for more.
So basically, when you look at any business tax returns, right, you need a 2 years of tax returns or a 1 year of a tax returns for the businesses.
2 years. So they
2 years.
must be, well, that being said, they must be in business for 2 years. Typically, we need to file tax returns.
Mhm.
There are some exceptions. Once again, we did have a client that I was able to get pre-approved with 1 year tax returns and then profit and loss. So we do
Yeah.
have some exceptions that we can do for that. They're supposed to be in business close, they're supposed to be 2 years. I have a little wiggle room with
Okay.
some of that.
So when you look at the profit and loss statement, right? So you are looking basically in an income part, expenses part, and in that expenses part, not only you're considering a net income, you are going in detail in the expenses, sometimes which you can add it to a net income, like you're talking about what all you can add back to a net income so that they can
So,
qualify
yeah.
for the numbers.
So some of the accounting stuff, which is depletion and depreciation, usually are the typical two that we add back in.
So listeners, if you're filing for a business tax returns, right, consider that points, right? When I know as a business, there would be a lot of expenses goes in around, but how do you structure your taxes? Talk to your tax experts because sometimes this depreciation will be helping you to qualify for a better loans when you're purchasing it. So you need to basically consider that. So that way you can call when you're planning to buy your first house or a second house, so that they can help out. So recently, April, like I think you helped one of my client also on this business related. I think they were running in 2 years, and thanks for that one also helping them to get for more than a 2 million, close to a 2 million purchase because a buyer was like, Nagaraj, no, I want to buy for a 2 million. Can you get me a pre-approval for that?
Yes. Yes. And actually what's kind of important to do too is if you're self-employed and you know you're going to be purchasing a home, say, 2024. So let's say this year. I have many clients that before they file their tax returns for the previous year for 2023 to
Mhm.
say, hey, because they know that they can file them a number of different ways and, obviously trying to minimize their tax liabilities, but obviously they still want to qualify. So what do I need? And so I do this for a lot of people. I actually did this also for my CPA back in the day when he and his wife were looking to purchase a home. He said, April, what do I need to do? So I even helped him, who, is a very skilled tax professional, to help him figure out what he needed. So a lot of times that's a good idea to at least, or if you have tax returns that aren't filed yet, but they're
Mhm.
prepared, hey, send them over to me and I can tell you what your qualification is, and then you can make any adjustments before you file them. So
Yeah,
that could be a
that's a
really
good
good idea
idea,
as well.
basically, because I think recently one of my client also before they're almost about to sign, they said, okay, let me file for 20, show my 2023 tax returns to my mortgage consultant and get the idea how much they can qualify. Because if some of the expenses they need to fine tune. I think let's put it, they need to fine tune, then they can do it better. Listeners, thank you so much. I think we're running out of our time for today, but all these recordings will be uploaded in my Nagaraj Annaya's YouTube channel. Do watch out for this, all these recordings, and don't forget to like and subscribe for more real estate insights. Thank you, April, and you can give out your number so that listeners wants to reach out, they can reach out to you.
My direct number is 949-306-8100.
Yeah. Listeners, if you want to reach out to me, go to nagarajhomes.com, click on the WhatsApp icon, and you can easily reach out to me there. And one more thing, I've recently updated my new website. Do check that and let me know how do you like about it. It's a completely revamped site, and you can get your free estimations of your home within a touch upon a button. Click on that, and if you have any questions and if you want to share anything, do let me know. Thank you so much, April, for joining in today. Have a wonderful evening, listeners. Thank you.